Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Christine Lagarde hints the ECB could hit the pause button on rate cuts this month as Europe awaits the latest inflation readings.
It will take time for us to gather sufficient data to be certain that the risks of above-target inflation have passed.
We will be speaking exclusively with the ECB's Chief Economist, Philip Lane, this hour. Wall Street maps out what a second Trump presidency could mean for the bond market after the Supreme Court ruled he has some immunity from criminal charges. Meanwhile, the Democrats may formally nominate Joe Biden as early as this month. Plus, the tale of the EV rivals. Tesla sales look set to fall again as BYD hits another record. European futures pointing lower after the gains that came through yesterday. The focus, of course, on the politics still of France and the US. We talk about how investors are evolving around the view in terms of a potential Trump presidency. Indeed, we will check in on the Treasury markets because you did see a sell-off yesterday. That has reversed to some extent, moderately, so far in the session today. European futures then pointed lower by 0.2%. Here in the UK, the FTSE 100 looking to lose around 30 points. Shop inflation, by the way, falling to its lowest level since October of 2021 here in the UK. S&P futures pointing to a loss of around 11 points so far in the session. Nasdaq futures looking lower by around 0.4% after the mega cap gains came through yesterday, with Tesla shares soaring around 6%. But again, moderation as we lead up to the open in the US later today. Let's flip the board and have a look cross asset then. We talk about the inflation story in the Eurozone. Broadly, you're expected year on year for that number to come down to around 2.5%. The data out at around 10 a.m. UK time. We've been hearing, of course, from Christine Lagarde, expectations the ECB will pause at least this month in terms of the rate cutting cycle. 4.43 on the benchmark 10-year. Again, after yields moved higher yesterday as markets adjusted to the prospects of potentially that Trump presidency. 4.43 on the 10-year. Euro dollar on 107 currently. It was impacted, of course, by the politics of France yesterday. A bit of a gain yesterday in the session. Currently down 0.1%. More about dollar strength that's coming through from the session right now. Brent crude at $86 a barrel, gaining 0.2%. Partly on the geopolitics as we look to a potential conflict or at least escalation between Hezbollah and Israel, but also as well what is evolving in terms of the supply constraints and Hurricane Beryl, which has been upgraded to a Category 5 hurricane. Gold trading at 2,327, down 0.2%. Let's cross over to Asia now, where Avril Hong is standing by in Singapore for a check on the Asian markets. Avril, what's standing out to you this morning?
Yeah, I think the dominant theme is how traders are bracing for this possibility of Trump 2.0. The way you just talked about, it's playing out in those U.S. yields, particularly on the longer end of things, fueling the strength in the greenback. That has implications for Asia FX, of course. And we are seeing across stocks, although the dominant theme about Trump possibly coming back for another 4 years is the back of mind, we are seeing a bit of a divergent performance among equities. For example, on the Nikkei, that outperformance is helped along by the financial-related names, as those expectations of a BOJ rate hike helping potentially their profitability. But in South Korea, the drags coming through from automaking-related stocks, Hyundai, Kia, after weak U.S. sales raised concerns about their earnings. Hong Kong back from a public holiday. The Hang Seng is recovering some lost ground, and this is fueled by some of the EV-related names. But the dominant concern, I think, going for these Chinese mainland markets is still about the economy. The stock market has been badly beaten up, along with the housing market. But the outlier for the Chinese assets, of course, is what we're seeing in Chinese bond space. Flip the board, as we saw that rally yesterday, really taking those yields to record lows, and then the PBOC late in the session coming through with an announcement about how it would be borrowing government bonds. That raised speculation that it could go on to sell securities to curb the rally in China. Chinese bonds. And for context, it doesn't want bonds to just be moving in one direction. But today we're actually seeing that rally resuming in Chinese bonds, and they haven't just been outperforming versus other asset classes, there's also that outperformance versus global peers. Of course, this is underpinned by the concerns related to the Chinese economy as well, how inflation in China, the picture there is really different compared to what we're seeing in some of these other major economies. Let's flip the board and take a closer look as well as how all this concern is playing out in dollar China. It's just been nudging higher. We got the tweak from the yuan fix again today from the PBOC. Offshore sitting well above 730. On the onshore yuan, weakest level since November last year. Of course, the yen has been on the back foot amid all this. It's the story of the dollar strength. But the other currency I wanted to highlight in Asia, the Korean won, was performing currency today in the region, and this is after an inflation print that showed further cooling, raising bets that we're going to see those BOK rate cuts as soon as August. Tom.
OK, Avril Hong in Singapore with a check on the markets and ending on the Korean won and expectations that maybe inflation is slowing there more quickly than some had expected. Avril, thank you very much indeed. Talking of inflation and central banks, ECB President Christine Lagarde says the bank there in the Eurozone, of course, does not yet have sufficient evidence that inflation threats have passed, feeding expectations that officials will take a break from cutting interest rates this month. Lagarde was speaking at the ECB's annual Central Banking Forum in Sintra in Portugal.
We are still facing several uncertainties regarding future inflation, especially in terms of how the nexus of profits, wages and productivity will evolve, and whether the economy will be hit by new supply-side shocks. And it will take time for us to gather sufficient data to be certain that the risks of above-target inflation have passed.
OK, let's get more from Bloomberg's Alex Weber, who is in Sintra for us. Alex, what else did Christine Lagarde have to say? And is it the understanding of those on the ground at Sintra that the door is now closed to a potential additional cut from the ECB this month?
So it was in very many ways a backward-looking speech from Christine Lagarde, which shows you that policymakers are still coming to terms with what happened over the last 2 or 3 years, and that this interest rate cycle has been really unusual. And that's really also the sense we get when we talk about what's happening next. So the situation at the moment is very strange in a way because we have interest rates near record levels. The labor market is still pretty strong. Yes, the ECB has an outlook which says they're going to hit 2% next year, but officials are really cautious and want to see that the economic data confirms to this assumption. And that's why Lagarde struck this cautious tone, seemed to imply that the door was indeed closed to a cut in July. And that's also the sense that we're getting from other officials, that they really want to see how the data develops and then take it step by step. There's really no rush because the labor market is so strong. There's not really a risk that the economy is derailing, so they can take this step by step.
OK, so caution, and there's seemingly consensus around the need to proceed with caution. We'll see if that is a consensus. What else are you hearing? What else are you expecting to glean from this forum in Sintra, Alex?
So there's going to be more soul searching this morning. We're going to have a session on the drivers of this post-pandemic inflation surge. There's a debate going on whether it was driven by demand or by supply. So that's really a bit the theme of this whole conference. There's also a session on geopolitics, which is a very topical at the moment. We have potential threats coming from around the world, also from within the Eurozone, of course. The situation in France is a topic on the sidelines. We've discussed this with some officials in past days. It seems they're not too concerned about the situation at the moment, but this is also something that is going to come up again.
OK, Bloomberg's Euro area economy reporter on the soul searching by the ECB at that Sintra Forum. Alex Weber, thank you very much indeed. And of course, Alex and the rest of the team will be bringing us that reporting and the analysis throughout the next few days, of course, from Sintra. Don't miss our exclusive interview, by the way, with the ECB Chief Economist, Philip Lane. That's at 6:40 a.m. UK time. It's an exclusive. You need to tune in for that if you want a clearer understanding of where the ECB stands on the question of inflation and the next steps for rates. Staying with the region, Euro area CPI due out at 10 a.m. UK time today, as I mentioned, giving policymakers an update then on price pressures across the continent. At this point, let's bring in Mary Nicola from Bloomberg's MLive team. Mary, how much progress are we expecting towards that 2% target for the ECB, and how much conviction do we have that inflation is moving in a sustainable way towards that 2% target?
Well, if yesterday's numbers out of Germany were any indication, it does look like inflation is stabilizing, at least the headline numbers. The key thing still is services and how services inflation is going to unwind. But overall, the trajectory does look positive, so indicating that we could see further downside on inflation. We could see some of the concerns from the ECB easing heading into at least September. So going into September, they'll have a few more readings before they decide on whether or not to cut interest rates. Of course, July is probably likely off the table, but of course it puts the onus on September. And a few more readings where we see the stability in inflation could push the ECB into that direction and into cutting a little bit more.
Mary, switching focus to the US then. And this is fascinating in terms of how we link the market moves, particularly in the bond markets, to that disastrous debate, of course, for President Biden, but also that ruling, momentous ruling from the Supreme Court that came through yesterday. And the bond market's now adjusting and starting to price in, at least around the edges, a potential Trump victory in November. And what that could mean for inflation. What are we hearing as markets adjust to that potential reality?
Yeah, one of the main things that we're seeing from the bond market is showing the upward pressure on yields. Of course, the market is looking at a Trump presidency as more of a ballooning fiscal deficit. But it's worth keeping in mind that no matter which party wins, it looks like fiscal prudence is completely out the window. What the two different parties have shown over the last few years. It's just a matter of what each party will spend on. So, for example, the Republicans might spend more on tax cuts, whereas the Democrats might expand spending overall on certain Medicare, Social Security, etc. So it's a matter of, upward pressure is going to persist on yields because of that. But also adding to the inflationary pressure is a Trump presidency and, of course, the expectation of potential tariffs on imports. And that essentially is going to fuel expectations of what the inflation expectations could become and what could happen with potentially what happens with the Fed and the likelihood of actually being more prudent than it was originally. So there is a lot to unpack here in terms of what are the potential implications on bond yields, but it looks like the longer end is going to be impacted as we inch closer to the elections, which is still quite a few months away.
Mary Nicola, thank you very much indeed from Bloomberg MLive on the analysis. As we look at the 30-year stateside at 460, the 10-year at 443. So the sell-off just easing somewhat in the session, but again, not making up for the losses that came through yesterday. Mary, thank you very much indeed. You can get a roundup, of course, of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go. There is plenty, of course, to focus in on, including how the bond markets are adjusting to the prospects of a potential Trump presidency in November. And what that would mean, of course, we've been discussing the inflationary input, if indeed he goes through, with his pledges around tariffs, immigration and tax cuts, just some of the factors that could feed into higher prices. And in terms of the day ahead story, let's focus in on the inflation story, but unpacking that and getting a preview, of course, with Mary in terms of what comes out. In terms of the price pressure in the Eurozone, 10 a.m. UK time then, expected to ease, headline, year on year to around 2.5%. We'll see if that is confirmed. Bloomberg Economics thinks we will be getting back to that 2% target for the ECB by the second half of this year. That data dropping 10 a.m. UK time. Meanwhile, the focus on the US at 3 p.m. UK time, the job openings data. We know this is really important for the Fed. We know Jay Powell scrutinises this, particularly the ratio between openings, job openings and employment and the jobless rate. So that ratio is crucial as well. So job openings coming through 3 p.m. UK time in terms of to what extent that's going to build into the picture for the Fed. And then on the corporate front, after that record number of deliveries, BYD, likely a very different story for its key challenger and competitor, particularly in the Chinese market, Tesla, with second quarter deliveries and expected to be challenged again. So that data coming out later today, and we'll get a preview of that in the next few minutes. Coming up, Joe Biden's nomination could be rushed forward to as soon as the middle of this month. That story is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Tuesday. Now, Bloomberg has learned that the Democratic National Committee could formally nominate Joe Biden as early as mid-July. The move would help stamp out talk within the party of replacing him after last week's poor debate performance. Bloomberg's Kriti Gupta has more. Kriti, what is the rationale for this? What does it mean in terms of where the party is after that freak-out, frankly, on the back of that disastrous debate for the presidency, for the president? We know that internally they've been talking about possibly replacing him. A lot of voices coming out and then behind the scenes as well. Yeah. But now they're putting forward this date. What is going on and to what extent have they rallied the carts around the president?
So it seems like they're pulling forward the date, but in actuality, this has been going on for a while. They've always said there would be a virtual roll call specifically because of some of the ballot decision making. So, for example, to get on the ballot in November, you have to meet certain qualifications and you have to do them or at least file for them in certain states in the month of August. So likes in North and South Dakota is August 13th and 14th. Ohio is August 7th. So the Democratic Party always knew that they would have to basically decide on a nominee before the ballot deadline, even if it kind of was preemptive to the actual Democratic convention itself. This wasn't an issue when President Biden was the presumptive nominee and still remains to be the presumptive nominee. The dates and the timing didn't quite matter. And the way they were going to solidify that was with what they're calling a virtual roll call. However, now it seems like with the panic that you are referring to around whether or not Joe Biden is actually the best person to represent the Democratic Party in this race, that roll call, the timing has now been solidified. And that's what I think people are reading as pulling forward to around July 21st seems to be the expectation. But remember, the timing is really crucial here because at the same time you have in mid-July this virtual roll call, which again is expected by Joe Biden to become, again, the official presumptive nominee. He already has all the electoral votes he needs by law. The swing states that he won in the last election, those electoral votes are already a part of his kind of base, if you will. That also comes just a week after, about 10 days after, if July 21st is the date, is President Trump's sentencing. So there's still a couple of weeks to go in terms of geopolitical events and political events in the state.
Which is just a reminder of how historic this election is, isn't it? And we'll see if it closes down that debate in the Rancor around Joe Biden, whether or not they should be considering a different candidate. Meanwhile, the president coming out and slamming, in pretty direct terms, this Supreme Court decision, which was split on ideological grounds around immunity for some areas, official acts of the president. Let's take a listen.
No one is above the law. Not even the President of the United States. With today's Supreme Court decision on presidential immunity, that fundamentally changed. For all practical purposes, today's decision almost certainly means that there are virtually no limits on what the president can do.
OK, so President Joe Biden there saying that no one is above the law, but the Supreme Court ruling suggests that indeed the president in some areas is above the law. This was a momentous decision. What does it mean?
It was a momentous decision. Basically, this is on a particular court case. Remember, he's got several overhanging him. Some of them have to do with classified documents. Of course, the hush money payment to the adult film star Stormy Daniels as well. There's several of these, but this one was related to his efforts to overturn the results of the 2020 election. This went all the way up to the Supreme Court, asking about the level of his immunity. To your point, the initial question was, does he have a legal shield? Does he have some sort of diplomatic immunity simply because he was president? president. And instead, the Supreme Court answered that by saying, you're asking the wrong question. The question is, what did he, to your point, do in his official capacity as president and in his private capacity as well? They still haven't figured out what that actually means. They've actually kicked it down to the lower courts. But what they're saying is if you separate the two, that's when you can know what those convictions actually look like or what those charges even actually look like. But the Supreme Court basically saying that there are some things that he could have done, things like speaking to some of the electoral voters, for example, speaking to the attorney general. Those were done in the act of as a president to potentially, and again, this hasn't been confirmed, protect the democracy. That is the argument that they're making.
So it gets kicked down to the lower court, as you say, and they're going to have to work through what is defined as personal, what is defined as official.
Yeah.
And that, of course, delays the court decision or when this goes to court, if it goes to court. But ultimately, this could be a president who is in power by then. And so that it seems like this case is standing on very thin foundations at this point.
Well, the timing is everything here. And look, this is to your point, being kicked down back to the lower courts to decide what that separation actually looks like. Tanya Chutkin is the district federal judge who is overlooking this. So she says that she now has a couple of weeks, potentially months, to actually go through with this. She's also said in previous proceedings that you need about 2 to 3 months of prep time for a trial that takes about 2 to 3 months. Do the math on that. That's about 6 months of just around the trials and tribulations, quite literally. That's separate from the actual parsing out of what's official and what's private. So do the math again, and you're not going to hit November 5th, even in terms of the start of the trial date, much less the end.
OK, it's been interesting to see how the polls reflect some of this, because, of course, when rulings have gone against Trump, he's benefited, this ruling going in his favour. So we'll see how that reflects in terms of how the polling shifts as well. Kriti Gupta with a breakdown of a really historic day for the Supreme Court in terms of how this ties into that race leading up to November. Thank you very much indeed. Of course, anchor on the opening trade. Coming up, a lawsuit accusing the trader known as Roaring Kitty has been dropped, quite mysteriously. We'll have the details on that next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to some other stories making news today. This is potentially really impactful. Hurricane Beryl has reached Category 5 strength as it heads across the Caribbean. For Jamaica, that is the earliest point in the year that an Atlantic storm has reached that strength ever. The US National Hurricane Center, I should say ever recorded, of course, says maximum sustained winds have increased to around 260 kilometres per hour with even higher gusts. Now, this story is evolving. We'll keep across it for you, of course, and it's having an impact on the oil markets. We check in on Brent and WTI right now because oil is close to a 2-month high. Yes, there's the geopolitics. There is, of course, the clash at the northern border of Israel and Lebanon, and we continue to monitor that as well. Tensions between Israel and Hezbollah, certainly a key concern in that part of the world, but also the potential impact of Hurricane Beryl, which is now a Category 5 hurricane. You can see Brent up 0.2% in the session today. WTI closing in at 83.51, close to $87 a barrel on Brent, again at a 2-month high. We will continue to monitor the oil prices on the back of the geopolitics and Hurricane Beryl. Now, switching focus, a fraud suit against stocks influencer Keith Gill has been dropped within days of its filing. A GameStop shareholder had accused Gill, also known as Roaring Kitty, of engaging in a pump and dump scheme. It's unclear why the suit was dropped. Gill was one of the faces of the 2021 meme stock craze and re-emerged in May with new posts about holdings in GameStop. Coming up, BYD sells a record number of cars in the second quarter. Tesla, however, is struggling to accelerate. The price-cutting story, the competition in that key Chinese market and the divergence that is occurring between BYD and Tesla. We get a preview next of what this all means in terms of that rivalry. Stay with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Christine Lagarde hints the ECB could hit the pause button on rate cuts this month as Europe awaits the latest inflation readings.
It will take time for us to gather sufficient data to be certain that the risks of above-target inflation have passed.
We will be speaking exclusively with the ECB's Chief Economist in the next few minutes. And Wall Street maps out what a Donald Trump presidential victory could mean for the bond market. Meanwhile, the Democrats may formally nominate Joe Biden as early as this month. And it is the tale of the EV rivals. Tesla sales look set to fall again as BYD hits another record. We unpack that story for you in the next minute or so. Let's check in on the markets, though, because European futures are pointing to, well, modest losses after the gains that came through yesterday. Dollar strength and, of course, the sell-off in the Treasury markets yesterday on the back of that reassessment of the political risks in the US, or at least expectations that maybe Trump has a better shot leading up to November. You do have a bit of money moving back into Treasuries, but not pairing the losses of yesterday. European futures then pointing lower by 0.1%. The FTSE 100 here in the UK lower by 21 points. Shop inflation getting back to levels we haven't seen since October of 2021. Unlikely, though, to shift the political dynamics. They have it at the vote, of course, on July the 4th. S&P futures currently pointing low by 0.2%. Nasdaq futures after the lift that came through yesterday. Mega cap tech at play once again, currently pointed to losses of 60 points. Let's flip the board and look cross-asset then. The Treasury's in focus, particularly the long end, on this really crucial assessment by the markets that Trump now does stand a better chance come November. And the potential inflationary risks of a Trump presidency. 443 closing in on 450 on the US 10-year benchmark. Yields just adding lower in the session by 2 basis points. Euro dollar at 107, a little softer by 0.1%. Brent crude up to levels we have not seen in the last 2 months. 2-month high for Brent on the geopolitical risks, but also Hurricane Beryl as well as it storms across the Atlantic. Currently up 0.2%. And gold, year-to-date gains of around 13%, just off in the session by 0.2%. Let's get to the corporate story with a focus on Tesla and EVs. Chinese car maker BYD sold a record number of electric and hybrid cars in the second quarter. Price cuts and new technology helping to stoke consumers into purchases. Let's bring in our Asia transport reporter, Danny Lee in Hong Kong. Danny, build your dreams. BYD, the shares trading lower in Hong Kong despite this. What do you make of that? I mean, it's been interesting to see the marketing campaign of BYD at the Euros, by the way. Not seeing much advertising for Tesla at the Euros, a lot for BYD. But they're coming through with a record number of sales. Investors, though, still a little cautious, it seems.
Yeah, I think investors are looking out to see if this momentum that they've had of the last couple of months can be continued into the rest of the summer, into the third quarter. And the initial verdict is maybe not, because of the low season we see during the summer period. That means sales fall, and really automakers are going to have to cut prices again in order to stoke demand. And so for BYD, who's had to cut aggressively in order to get to where it is today, it's not necessarily good news for BYD, for the rest of the industry, because if BYD cuts, the rest of the Chinese EV industry also has to cut. So this is investors taking money off the table for BYD, where shares have risen to a pretty decent level of late.
Danny, what is your assessment in terms of BYD besting Tesla on the pure EV part? Because, of course, BYD gets a number of sales as well from hybrid. When it comes to pure EV, do they beat Tesla?
I think the matchup is actually quite close. I mean, Tesla, its quarterly numbers look to land around 439,000. That's the average analyst estimate. But for BYD, we already know the number, and we're about 13,000 or so short of BYD overtaking Tesla. But Tesla has a lot of downward momentum, frankly. And so even if they miss by a small margin, they could be overtaken by BYD once again as the biggest seller of EVs.
And Danny, to kind of round out the picture, we're going to get the numbers from Tesla later today. What are we expecting? How bad is it likely to be, or at least how challenging has the most recent quarter likely to have been for Tesla?
We're likely to see another consecutive quarterly drop in sales year on year. So that's a rare time that it has happened. But for Elon Musk, Tesla, they're running out of excuses, frankly, to explain away the fall in sales. And you have to then look at its overall lineup. Its lineup is fairly stale. They are trying to push through improvements, but as Elon Musk had warned earlier, they were going to see a pretty down year on sales. So if we do see another downward picture, shouldn't be too much of a surprise, but it just remains to be seen where the numbers land.
OK, Asia Transport reporter Danny Lee, who will be kept busy with that story. With the details, the preview, of course, of the Tesla sales numbers expected later today. Danny, thank you very much indeed. Now to some other stories making news this Tuesday. Antitrust enforcers in France are reported to be preparing to charge Nvidia with allegedly anti-competitive practices. According to the story from Reuters, France would be the first country to take such a step. Antitrust enforcers raided the offices of a business suspected of engaging in anti-competitive practices in the graphics card sector last year. Nvidia has been contacted for comment. Staying with France, the leaders of the biggest political groups have been reaching out to voters from across the political spectrum as the battle for the second round of the election turns into a scramble for parliamentary seats. Centrist Prime Minister Gabriel Attal and Jordan Bardella of the far-right National Rally both took part in TV interviews yesterday amid intense horse trading for alliances. Voters head back to the polls in France on Sunday for that second round vote. Switching focus to the UK right now. Inflation in UK stores falling close to zero for the first time since October of 2021. The British Retail Consortium says shop prices were just 0.2% higher in June, down from 0.6% in May. The drop was driven in part by discounting of general merchandise items like TVs and a continued fall in food price inflation. Voters in the UK, of course, will also be off to the polls on Thursday. The inflation data, though, arguably not going to be much of a benefit to the Conservative Party. We'll see how it comes through, of course, but the polls suggest that hasn't yet changed the dynamic. One challenge, though, facing the next government, whoever it is an existential crisis in universities. Stagnant fees and inflation are squeezing higher education institutions, with the sector losing valuable international students. Universities are calling for swift action.
As an absolute minimum, we need to start increasing the fees in line with inflation year after year. And of course, once again, getting across, this isn't money that students have to pay up front. This is a basis of a graduate repayment scheme. However, I think we probably also do need a step change up from 9,000, and who knows, by 1,000, 2,000 or something. And for that, there needs to be a wider settlement with whichever party is the new government.
OK, Bloomberg Radio anchor Caroline Hepker has a special podcast out today on UK's universities, and she joins us now. And this is a really essential part of the UK economy, a success story, but being challenged. What has led to the problems facing this sector then?
Yeah, I think perhaps a lot of elements in the UK economy are going to need an overhaul, but perhaps this one particularly because it's so important in terms of skills and economic growth. The issue is that student fees paid by undergraduates in England, £9,250, that has remained stagnant since 2017. You've also seen a dramatic decline in international students because of changes to the visa regulations under the Conservative government. And you've also got the Office for Students saying that actually out of England's universities, 40% of them are going to run a budget deficit this year. So this is why we've spent a lot of time thinking about higher education. We know that it is crucial to the services economy of the future in the UK. Helen Chandler-Wild and I have put together this podcast speaking to a whole range of people, including Lord Willits, who was the universities minister at the time when we last put up university fees in 2012 up to £9,000. He now says that he regrets not indexing those undergraduate fees here in the UK. He's basically saying that there's going to need to be pretty much immediate change, increasing those fees every year. And so we've spoken to him and also a number of vice-chancellors who want change under the next government. We've called the podcast University Challenge.
OK, nicely named. So and it's controversial, obviously. Raising prices and raising the ticket for students will, of course, create controversy. But as you say, there is a need to address the funding gap. What is in the manifestos, then, of the parties? What are they going to do? Is there any hope that the main parties are looking to address this in a serious way?
Now, the manifestos promise rather little, and that's the problem. Labour does call the sector crisis hit. They talk about securing the future of higher education, but they don't say how, and they don't actually assign any funding to it. They dropped the pledge that they had back in 2019 that they would drop university tuition fees. They are such a hot political issue and they caused a lot of protests from students. They've dropped that pledge back from 2019. But they're not sort of saying how they're going to resolve the issue. Also, the Conservatives haven't pledged any new money. The issue also is that running alongside this is the idea of increasing apprenticeships. That's something that the Conservative government has focused on a lot, talking about scrapping rip-off degrees, the sort of terminology that that the sector really dislikes hearing. And yet, we've also got a separate piece out from our colleague Irina Angel this morning, looking at the Reed employment data, that actually shows that university degrees are still the thing that employers want even more now that we're seeing unemployment tick up in the UK, and that actually that push may be going into reverse, even though a lot of businesses have talked about dropping the requirement for degrees.
Really interesting. A deep dive, of course, in the podcast out today. Caroline Hepker from Bloomberg Radio on that crucial sector for the UK economy as we run up, of course, to the Thursday general election here in Britain. Coming up, our exclusive interview with ECB Chief Economist Philip Lane at the ECB Forum in Sintra. That is next. Stay tuned. This is Bloomberg. The lens very much on the ECB this week. An ECB Governing Council member, Pierre Wunsch, says he would need more convincing that inflation was headed back to that 2% target for there to be more than 2 rate cuts this year. Wunsch spoke to Bloomberg at this year's ECB Forum in Sintra, Portugal.
We are close to 2%, so we are really talking now about relatively small deviations, which could come from various fronts on the upside and on the downside. The economy is not very strong. We hope and we believe it's going to recover, but it's not very strong. We have uncertainty on wages, we have uncertainty on margins, we have uncertainty on energy prices.
Well, let's cross over to Sintra now, where Bloomberg's Francine Lacqua is standing by with a really essential guest, essential interview. Francine, good morning.
Good morning, Tom. I'm delighted to be joined by the ECB Chief Economist, Philip Lane. Mr. Lane, thank you for joining us.
Good morning.
Early in the morning, really, to get us started for the day ahead. There's a bit of political drama, election drama in France. Does that complicate the way that you see the Eurozone economy?
Well, the election, round 2 is next Sunday. So after that, the election will be over. Of course, let's see what the new government, its policies, its plans for the future. There are elections all the time. We will have to see what the new government decides. But we do have very important, I suppose, guidelines in the euro area. We have a fiscal framework. We at the ECB have advocated that all governments in Europe should be promoting faster growth in the economy, structural reform, supporting banking and capital markets union. So within the context of what we want, let's see what the new government decides.
Are you worried about the spread that we've seen, the widening of the spread between German and French?
Well, of course, I mean, spreads move around all the time. It's clearly natural in an election for the market to reprice. So I think, again, there are elections all the time. There have been movements in spreads all the time. Of course, France is a very important country, but this looks like an orderly repricing to me.
So you don't see at this point the need or to talk, or is it a possibility that the ECB has to use some of the tools at its disposal?
So I think it's important to be very clear about this, that it's very important, and I'm very glad we do have the transmission protection instrument, the TPI, but it's clear also this is important in the event of unwarranted disorderly adjustment. And as I just indicated, we don't have the conditions right now for disorder. This is an orderly adjustment. And, it's important in the area that we let the market reprice in an orderly way.
I mean, there's also, PEP is going down. Does that make a difference technically into some of these things and how they're seen?
No, I think, PEP remains with us for the next 6 months. I think it remains important. But, of course, it's for the next 6 months, and then we'll be run off. But we know we have a very general framework. So I think we know when it's important to let the market reprice in an orderly way, and we also know the conditions under which it might be necessary for the ECB to play a role.
Where are you in the fight against inflation?
So we're in mid-twos. And what we said in the June projection, essentially we're going to be in mid-twos into early next year. But then I think there's a lot of foundations in the movement from this year to next year to see inflation come down to our target in the second half of next year. And I think what we've seen the last day or two with the early indications of the June inflation data is in line with that assessment.
But is it too early to cry victory? And so what does that look like in terms of future interest rate cuts?
So I know it's a very natural question to ask, and what I've said before is under the baseline projection in June, of course we're not going to remain where we are. Now, we have essentially 8 meetings between now and this time next year. This time next year, again, under the projection, we're going to be looking at the second half of 25 at target. So clearly, being at target and having an interest rate at 3.75 is not where we're going to be. But the exact timeline will depend, I think, as President Lagarde said in the speech last night, essentially looking for extra confidence about the, if you like, the remaining disinflation we need to do. And the key issue there is really services inflation. And what we've seen in the last day is essentially services inflation remaining the outlier. It remains relatively elevated. And what we need to see is that relatively high services inflation just a backward element? It's a legacy of the rapid disinflation that it's still working its way through services inflation, or is there any persistent element? And I think right now we need to take a little bit of time to work on that.
So, but given the current situation, everything can change. Do you see 2 cuts this year? Or is
I don't think this is a very interesting question for me to answer for a couple of reasons. One is this calendar year is not a very natural way to divide up our monetary policy challenge. Second, the market has repriced a lot over the year. So the current market pricing, it doesn't really add value for me to say very much about that. What I would say, and again, coming back to President Lagarde's speech last night, is we have to look at the inflation data, and we also have to look at what we can learn both from the GDP data, and in our July meeting, 2 weeks away, we're going to have the corporate telephone survey. We'll listen to the firms, and that's often a good early indication. We're going to the bank lending survey. We're going to have the SAFE survey, which lets us know about small enterprises. So actually, in the July meeting, we're going to have a lot of soft data, like survey-based data, but in terms of updating our views about where is the economy headed in the second half of next year. And that's an important intermediate step to the key September forecast.
I mean, there's so much debate on whether July is a live meeting. Do you think every meeting is live?
Well, I would say it's absolutely live. But very importantly, it's fair to say at this point, it's going to be live in assessing what do these surveys tell us. How is our attitude going to be updated? And really the questions for the July meeting are really, I think, going to be on the economic side. Where is the corporates telling us about their labour market plans, their investment plans, what are they seeing from their customers? So I think it's a very live meeting in terms of that. But of course, the June inflation data, which we've been waiting for, we have now. Well, there's a bit remaining in the course of today to get the final number. But what I've said to you on that is we still have questions about services inflation. They're not these data do not settle that. It's not an upside surprise. It's more or less in line with the baseline. But on that, we need a bit of extra time. But I think it's important in kind of mapping our way to September to really have a productive meeting next week when we really take into, or 2 weeks from now, the survey data we will receive.
And how does the Fed complicate things and the fact that they've been so reticent? I know of course, ECB sets monetary policy for the region, but there's always a gravitational pull towards the Fed.
Yeah, no, I think I have to disagree with this. I know because in the end, what's going on in the US economy has multiple effects on Europe. The The exchange rate effect works in one direction, the bond market effect works in the other direction. So essentially, in terms of all the things we can talk about, the spillover from the Fed to the ECB is, way down the list of influences on our monetary policy.
Phil Blaine, there's a belief, I guess, because of previous cycles, that once you start cutting, you cut, right? Maybe not gradually, but you continue cutting. Is this cycle different?
Well, effectively, as I said to you, we have an inflation projection around target a year, in the second half of next year. That is not going to happen if we remain at 3.75. So, as you said also, there's lots of, the world has lots of things going on. Let's see what the autumn brings us in terms of geopolitical developments, macro developments. So the overall pace of cutting, I think very importantly, and President Lagarde said it last night, is we do not have labour market pressure. So the traditional reason to cut rapidly is because you see a weakening economy, you see rising unemployment, and you need to move quickly. Right now, we do have a fairly weak economy. The economy is only starting to grow, but the labour market does have this very low unemployment rate. So we do have an opportunity right now is to take the time to really confirm that the upside risks to inflation are contained. And the urgency is not there. But of course, this is something where that can change over time. And so we're going to be keeping an eye on the real economy, the labour market, the overall growth dynamic in the economy, because that is a good leading indicator for inflation in 25. And inflation in 25 is really our focal point.
Philip Blaine, thank you so much for joining us today. That was the Chief Economist there of the ECB. With that, Dom, I'm going to send it back to you in London. We'll have plenty more throughout the day.
Bloomberg anchor Francine Lacqua with ECB Chief Economist Philip Lane. Thank you very much indeed. Scoring a redhead on the terminal, Lane saying that June inflation won't answer ECB questions on services. This is Bloomberg. Welcome back. Wanted to flag for you the job openings data coming out of the US later today, 3 p.m. UK time. The JOLTS number expected to come in below 8 million, 7.95 million is the expectation, with a focus on the ratio of job openings to the unemployed. Expected to come back down to levels below levels before the pandemic. Really crucial. We know the Fed looks at this. Plenty more coming up, including the opening trade with a bunch of guests on the ECB. Stay with us. This is Bloomberg.